There we go. Good afternoon, everybody. My name is Rich Harvey, CEO of Property Buyer. Thank you so much for spending the time with us today. And I'd like to warmly welcome Luke Gardner and Amir Ishak. Luke from Loans for Homes, a very skilled mortgage broker, and Amir Ishak, a tax guru with property tax specialist. So thanks, guys. Really appreciate you offering your time and expertise today.
Thanks for having us.
So, look, the format of today will be Luke will go first, talking about financing and home loans and a whole bunch of financing matters. Then I'll throw to Amir to talk about the juicy topic of tax and how to minimise tax, how to maximise your outcomes there. And then I'll be talking about some property purchasing strategies and some case studies as well. I'd really encourage you, everybody, to as we go along the webinar today, put your questions into the Q&A box at the bottom of the screen. So we will be spending 15 to 20 minutes at the end of this webinar. So please save your questions, write them in that box, and we'll try to get to as many questions as possible. So we love the hard-hitting questions, don't we, guys? The harder the better, right? So there's no
Absolutely.
impossible. So Luke, I'm going to throw it to you now, please, to kick us off with your presentation. Thanks so much.
Thank you, Rich. Thanks for having us. And I think a smart move as well, putting the most interesting topic of the three first.
That's it.
I'm just going to share my slideshow now. Just let me know if that's
All
coming
good,
through
mate.
okay on
Yep,
your end. Yep.
absolutely. 100% good. Yeah.
So yeah, this is my team here. That's me, that handsome fella in the middle. I think I cut my own hair for that photo. So Loans for Homes, the name of my business, established in 2012. We've got a team of six. Um, and what we specialize in is residential home loans, but we do asset finance and commercial SMSF as well. Anything that can be financed, really, we finance it. Our details are down the bottom there. What I'm going to talk about today, I'll just quickly go through the agenda with you. A few things. So first of all, structuring loans, the different types of features and benefits that you might be opting for when deciding on which loan to go with. Maximizing borrowing capacity. This is probably my favorite topic, and I think the main thing that you would go to a broker for. I know a lot of people think that brokers will find them the best rates, which yes, we can, but maximizing borrowing capacity, I think, is where we really add value to our clients. Mistakes to avoid, common pitfalls, and then there'll be some final thoughts and questions. But I think we're going to leave that until the very end when all three presenters have finished. So I'll just minimize this. Okay, structuring loans, interest only versus P&I. Something that we get asked a lot is, which is better? And there's no right or wrong answer. It depends on the individual set of circumstances, but some key differences between the two. With interest only or IO, lower repayments initially. So obviously improve cash flow or preserving access to your cash if that's important to you. Tax benefits for investors. There is no equity built whilst you're on interest only terms, but and higher costs over the life of the loan. But the really sort of important factor here is I think the preserving access to your cash or the lower repayments initially. So that can suit both investors and owner occupiers. So investors may be looking to build out a portfolio of properties over the next 10, 20 years, and they can afford to hold more properties in their portfolio if they've got them on interest only repayments as opposed to principal and interest repayments. It is important to note though, however, even though your repayments are lower from a borrower perspective, the banks are going to lend less to an interest only loan compared to an owner occupied loan just because of the way they assess the loan repayments on that. They assess your loan repayments over the remaining 25 years of the loan, not the full 30-year period. Principal and interest, we're building equity from day one. So, going to build equity over the life of that loan a lot faster and pay less interest, but your repayments are higher there. So, again, each to their own. I think it's important to discuss the options with your broker and find out what's best for you. But typically, we find owner occupiers prefer the P&I and investors the interest only. I've done a quick case study here, and I'm not going to go through it in great detail because these slides will be sent through to you after the presentation. But I've got customer A here paying principal and interest on a $600,000 loan. Their repayments are $3,536 a month P&I. I've actually broken that down for you. That's about $616 a month principal. Little disclaimer there, that is in the first month. and $2,920 interest. So the bulk of that payment in the early years of that loan is interest, okay? Versus an interest only loan at a slightly higher rate. That's the other thing, that the rates are slightly higher for interest only. The banks lend on rate for risk. Zero principal, obviously, as the name suggests, we're not paying off any principal on that loan. It's just interest. And the interest repayment on that loan at that rate is $3,020 a month. So difference between those two options is $516 a month. So you can see there from an investor perspective how paying interest only, they are going to free up their cash flow to be able to maybe buy more properties because they're going to have more disposable income to put towards the next one. But it is worth noting these two graphs or columns I've got here, the difference in interest over the life of the loan if you choose an interest only loan versus principal and interest. So if you're choosing customer B interest only, you're paying back in total principal, interest, fees and charges over the life of the loan about 1.32 mil versus 1.27 mil on principal and interest terms. So you're paying about $50,000 more in interest over the life of the loan by going with interest only. But again, a lot of investors don't care about that because it allows them to accumulate more properties and they're going to make back more in capital growth or capital gains by building out a larger property portfolio and not worrying so much about the interest difference over the life of the loan. So, yeah, case by case there. Fixed versus variable, another one we get asked all the time. It's probably my most dreaded question. This is the one that I don't like answering. I think it's like someone asking, to choose between black or red at the roulette table. We might all have an opinion on where rates are going in the short term, the immediate future, but we're talking about a 30-year loan term here. Even predicting where interest rates are going over the next 5 years, I think is near impossible, as COVID has proven. Things like that can really throw a spanner in the works and change that narrative very quickly. So it depends on your individual risk appetite. Some key differences between the two: obviously, fixed rates offer comfort, comfort and stability. Protection against rate increases, which might be important for some people. But there's also limited flexibility. You might have caps on how much you can make in terms of extra repayments. A lot of fixed rates don't allow for redraw or offset, and potential break costs if you get it wrong. So if rates, you fix in at a certain rate and rates drop, to break that and go to variable, it can be quite expensive.
So, Luke, can I quickly 10-second my little 2 cents
Yeah,
worth
mate.
on that? Try to bet against the banks. I often lose, right? The only
Yeah,
time that we all won was during COVID when we had emergency rates. I managed to lock in mine at 1.9% for 2 or 3 years. That was gold. So unless you've got some catastrophe coming and rates are at rock bottom, generally I find it's better to keep them variable. Yeah.
yeah, I'm the same. I've fixed, I think, probably twice in the last 20 years.
Mm.
Got it wrong both times.
Yeah.
So that's why I've only fixed twice in the last 20 years. Variable rates offer a lot more flexibility, no limits on extra payments. So again, depends on your individual circumstances. I think maybe if you're, say, I don't know, a single parent who's borrowed to your maximum capacity, living paycheck to paycheck with no money in the bank, and we're living in uncertain times where there's talk of interest rate increases, maybe that's, fixed rate might be the option for you just for a period of time until you're able to build up a bit more of a cash buffer or get a pay increase. But someone who's on a strong income, not borrowing to their maximum, got money in the bank or other assets like shares you could liquidate to get you out of trouble, or expecting bonuses or large sums of money to come in the near future, maybe a variable rate offers you that flexibility to pay it down quicker. So I think the theme is across all these options is case by case, based on the individual circumstances. My favorite topic, maximizing borrowing capacity. And again, this is where brokers add real value. So this is what people come to us for. Um, Rich, we talked about this last week or the week before on our podcast, and this is a point that you raised, which I hadn't really thought of, but it's more of a mindset thing. So people ask, how can we increase our borrowing capacity? You'll see points 2 through to 6 there are sort of tweaks that we can make to increase your borrowing capacity. But number one is a real mindset thing, right? We get clients coming to us saying, I'm maxed out, I can't borrow anymore. And they're on a certain income. And a conversation that you might want to have with yourself is, how can I increase my income? And a lot of people will say, oh, look, I'm at a ceiling. I'm in a profession that does not allow me to earn more than X. Um, and that's in your head, right? You can always go and study, whether that be, a night course or, something online that you do in your own time that is going to upskill you and improve your value to your employer, right? It's going to help you to go after those promotions and those pay increases, which will ultimately help you borrow more. Because that's what it's all about. Borrowing capacity is about your disposable income, how much you've got, and how much you can afford to pay each month on the loan. You can have as much money as you like sitting in cash savings, but if you're not earning an income or a high enough income, you're not going to be able to borrow anything from the bank. So upskilling, second job, whatever it takes to improve your income is a powerful one. But outside of that, reducing your discretionary expenses. So if you're spending a lot on Uber Eats and Netflix and other subscriptions, maybe you can cut back on that a bit because the banks do look at that. Lowering credit card limits. I've run a few scenarios recently, and as a basic rule of thumb, it's roughly 4 or 5 times your limit is, so a better way of explaining it, whatever you reduce your limit by on your credit card, times that by 4 or 5, and that's roughly what your borrowing capacity is going to improve by. So if you're going to drop your credit card limit by $5,000, you can borrow somewhere from $20,000 to $25,000 more with any bank or lender as a basic rule of thumb. Same rule applies to personal debts. So consolidating personal loans or car loans within the home loan or paying them off completely is going to increase your borrowing capacity by roughly 4 or 5 times the amount of that personal debt that you're paying off or consolidating. Um, Refinancing or extending the loan term is one that we use a lot. So we got clients that have come back after, they've taken a 30-year loan term and they've paid it down to sort of, whatever amount it might be, but they've got 20 years left on their loan and they want to then go and buy an investment property. They might be capped out on their borrowing capacity or not able to borrow as much as what they need to buy that investment. But by extending their term back over 30 years on the existing loan that they've got, that's going to reduce the repayments on that existing loan and increase their borrowing capacity for the next one. An important disclaimer there is that is obviously going to increase the interest you pay on that loan over the life of the loan. But again, if it gets you into that higher price bracket, that better property, it might be a cost that you're willing to wear. Finally, using a broker. You can't beat the broker proposition, right? We've got 60 plus lenders on the panel, tech and AI, which we just talked about, that can solve complex scenarios in minutes. I've got a tool that I use where I can enter your information, your income, assets, liabilities, credit card limits, etc., and tell you within 99% accuracy how much you can borrow with about 60 lenders in 5 minutes. You can't go to 60 lenders in 5 minutes and find that out yourself. So, and your borrowing capacity will vary quite significantly from one lender to another. And some of the sort of policy niches that the banks have that do differentiate how much they can lend you, things like bonus and commissions, how one bank to another, how they treat that. So some banks might take the lower of the last 2 years bonus or commissions, some will take an average, and some will take a higher. Allowances, company car. Some banks say if you've got a company car fully maintained, we'll add $5,000 or $10,000 a year to your income. If you are on parental leave, some banks won't lend to you. Some banks will say as long as you've got enough cash in the bank to see you through that unpaid parental leave period, then we'll use your return to work income. Some of them will shade that. Self-employed, again, some banks will look at your last 2 years tax returns and take an average of the two, or maybe the lower of the last 2 years. Some banks will take the higher of the last 2 years. And some banks now are looking at just your self-employed director wages. So if you run a company like yourself or I, Rich, and you pay yourself a salary, some banks now are saying, I don't even need to see the company returns. Just show me your pay slips and we'll take that income. So yeah, some real sort of, there's more we could go through there, but I've got a bit of a case study here, one that I ran the other day for a customer. So Bank A, Bank B, same customer. So customer that's gone to Bank A, $85,000 a year base salary. Their last 2 years bonus, they received in 2024, $30,000. And then in 2025, $60,000. So it's doubled, right? Bank, and the max they could borrow with that lender, which would take the lower of the last 2 years bonus, so the 30,000, they'd only lend them $580,000. All right. Bank B, exact same customer. they'll take the higher of the last 2 years and lend them 660. So they're getting $80,000. Same customer, same set of financials, just taking it to a different bank gets them an extra $80,000. Right, that's probably the most simple example or scenario I can put to you. We do a lot more complex than that, but it just shows you. I've seen some banks lending hundreds of thousands of dollars more just because their buffers are 2% lower than what most banks will assess your borrowing capacity on a 3% buffer, so 3% above the current rate that they're lending. There are some banks that will base it on a 1 or a 2% buffer. So, real big difference in borrowing capacity there. Tips to get the best rates and navigating policy. So, look, important to note, banks base their rates or price on rate for risk. So, the riskier the loan perceived to them, the higher the rate. So, the lower the loan to value ratio, that's what the LVR stands for, the better the pricing. So, the more skin you've got in the game and the more deposit, the more equity you've got in the property, the better the rate. So, you might start off and take a loan at 90%, put in 10% deposit, and your rate's going to be 6%. But over time, you've built equity, that property's gone up in value, you've paid your loan down, and you're now at 80% or 70% loan to value ratio. That bank's going to reprice that loan at a lower rate for you because there's a lower risk for them. Less chance of default, or if you do default, there's less chance that they're going to lose their money because they'll sell that property and pay that loan back. Maintaining a good repayment history. This is more for existing customers. So if you're an existing customer wanting a rate review, getting a better rate, bank's not going to reprice your loan and get you a better rate if you're missing payments each month or late on payments. It's they're happy to see you go if that's the sort of conduct you're showing on your account. So keep those repayments in check. First home buyer incentives. There's lots of schemes out there now that we can help first home buyers navigate through. First homeowners grants, stamp duty exemptions, first home loan deposit schemes, just to name a few. So if you're a first home buyer, reach out. We're happy to help navigate through those incentives for you and let you know what you do and don't qualify for. Industry perks and professional offers. This list is growing. So when I first started in banking, it was doctors, lawyers, accountants. They were the only industry professionals that had access to cheaper rates, right? Now, those medical professionals, we're seeing physiotherapists, vets, occupational therapists added to that list, not just doctors and registrars. So it's a growing list. If you, and even banking professionals, if you work for a bank, you don't have to be high up in terms of ranks. If you work for a bank, you can often get access to LMI, lenders mortgage insurance waivers, and better rates as well. So again, come and speak to us about those professional offers, and then review your loans regularly with your broker. We should be doing this proactively, right? Our business, Loans for Homes, we review our customers' loans every 6 to 12 months. So proactively, without the customer asking for a review, we go and do a review for them. And your broker should be doing that. If they're not doing that, then might be time to reconsider and switch brokers.
Fantastic, Luke. That's great.
How are we going for time, Rich?
Yeah, good, mate. Yeah. Anything else
We
you
all
want
right?
to
I'll
Mm.
keep on you. Okay. Investment finance mistakes. Let me know if I need to wrap up, mate. Sound the buzzer.
Okay.
So look, the main one, don't take advice from non-experts, all right? So non-experts are, it could be family, friends, people who don't really have any real world experience in investment or finance. They might own a property, right? They might own their property and have paid their loan off. It doesn't make them an expert. Some people make money in property through luck or just hard work. They get into the property market because they need a home and they don't want to rent. Property goes up in value, doubles in 10 years, and through hard work, they're paid to throw that advice around and tell you what you should and shouldn't do. Pay your loan off weekly. Don't switch lenders. Don't pay for professional packages. It's all well intended, but it's not necessarily the right advice. Advice should be personalized to the individual based on your individual requirements and objectives and set of financial circumstances. Social media is a big one now that we're seeing a lot of social media marketing experts out there flogging advice that is not always true. So yeah, that's something that I take as a grain of salt. don't try to time the market. It's a long game property. I've made this mistake of trying to, I suppose be a bit naive and greedy with property and bought or made some bad investments in my time, getting into the market in at the wrong time in the wrong market, buying the wrong property without expert advice and lost money or not really capitalized as much as I could have if I had sought advice from perhaps yourself, Rich, or a buyer's agent who had a lot more experience than me when it comes to property. And don't do it alone. Build a trusted team of experts. So mortgage broker, buyer's agent, accountant, solicitor. That's all you need, all right? An expert team around you that's going to guide you and provide you with expert advice and avoid making those mistakes. Common pitfalls. Poor credit management is one. So we see clients lodging multiple applications with multiple lenders, thinking that they're doing the right time. All right, I'll
No,
wrap it
just
up.
just wrap it up, mate. That's all good. It's
Wrap
the
it up,
last
mate.
one.
Yeah.
Yeah,
No, no. Okay. Look, planning is a big one. So, I think don't go looking for the house before you've got the loan. Get the loan pre-approval first. It'll avoid you missing out on those properties and avoid that disappointment. Have your documents already, send them through to the broker as per the checklist that they've sent you. And yeah, don't chase credit card points is another one. People love those credit card points. A few tips there. That's it for me. I will wrap it up there, Rich, and hand it over to Amir, I think is next. But yeah, I'll stick around. So if there's any questions after, I'm happy to answer those questions.
that's great. Thanks, Luke. There's a heap of questions already there on the Q&A ready for you to get stuck into.
Excellent.
Amir, without ado, if you could share your slides and love to hear your wisdom, please, from an accounting perspective on how we
Yep.
become better.
So, tax might not be the most interesting subject, but I'm sure saving money is for a lot of people. And that's the whole point. That's what really excites me. How do we legally save money and create wealth and add to the client's wealth? That's what I'll be talking about today. So let me just property tax specialist Shukri Barbara founded it over 35 years ago. He is my mentor and taught me a lot of what I know. I'm principal director. I've done a lot. I've worked in banks. I've worked in financial institutions. I've worked in builders, developers, and all this has bought, with time has got me to where I am today. Today's objective is only creating awareness. All what we're trying to do is ask the right questions and, more importantly, for you to be informed when making important decisions. There is a QR code that will appear. That QR code, if you scan it, enter your details, one of our team will get back to you for a 15-minute free consultation. So that, again, if you missed it, it's going to appear regularly through the slides. Today's program, we'll talk about the tax implications, capital gains tax, which is very important, especially with property, and what are the ways to minimize that, structures, what are the structures available to you, and I'll touch briefly on super. Again, the formalities, this is not intended to be advice. This is informative and education nature only. We recommend you obtain professional advice to suit your circumstances. I'm also a limited advisor with Merit Wealth. What that allows me to do is advise on super funds, creation, wind up, and borrowing within super funds. So if you want to buy a property, the LRBA part in that. All right, what do people want? What do you want? Most people want some cash flow. Some people want capital growth, development profits. That's something people look at as well. Maybe sharing in a bigger deal. You can't do the project on your own. How do you get a share of that deal? The whole point is start with the end in mind, like Stephen Covey said. So when you start with the end in mind, it becomes clearer. Your path becomes clearer. So we help people structure investments in properties to minimize tax, legally, of course, because you do not want to be audited by the ATO. So doing it right, structuring it right, and being ready should the audit come. Maximize your returns. Keep more of the asset or the wealth you've created. How do you protect your assets? You've worked hard. How do you protect your assets for yourself and for your children while keeping the ATO happy, which is very important? Okay, but my job is working for the client, not for the ATO. We do a bit more than that. We do cash flow analysis. We do tax returns, compliance, as well. So to start off with, to kind of put things in perspective, if someone is making $250,000 of income a year, first of all, they know what Division 293 is. And secondly, they will be paying about $83,600, which is 33% tax, average tax rate. If there is a way to split that income between two people, each person will be paying $30,000 or $30,700, which is less than 25%. That is a big saving. That's $20,000, $22,000 worth of saving. That could be part of a new deposit. That could be a new car. That could be a holiday. It could be a lot of things. But, how do we manage that? All right, where do you start when you're looking at investing? First of all, your life circumstances. And they changed, are you at the beginning of your life? Do you have kids, or are you approaching retirement? What are your personal tax circumstances? What are the opportunities available to you? Are you in a very high income bracket, or are you in a low? Do you have a big family group? All these things are part of the assessment. What structures are appropriate for your ownership, for your share? You need to test it and make sure that it's appropriate for your needs and your thing. And the other thing, the funding and financing requirements. How are you going to finance it and fund it? So that's a discussion you have with Luke. But it's very important to look at all these factors before you start. There are basics in tax planning. They are, how can we split the income? Like in the example I gave before, how can you split the $250,000 between 2 or 3 people to lower the average tax rate? Timing of receipts and expenses is very important as well. And that's what we do in tax planning for year-end tax planning for our clients. How, we see that, have they had a capital gain? Is there something they can do to lower their expenses? The timing of the capital gains. So bringing forward expenses or delaying expenses and receipts. The other very important thing in timing is capital gains tax is calculated on the date of signing the contract, not on settlement date. And we get a lot of clients who get confused on this. So if you're signing a contract in June and maybe delayed till July without losing the sale or losing some money, then you've just gained another 12 months of saving for the tax. You can use that money for whatever you want. So these are very important considerations. Then structuring. What structures are available? How to use them to your advantage legally. Okay? Why do people structure? What is the benefits of structuring in the first place? And when I say structuring is how they structure their assets, who owns the assets, and how are they owned in different entities to protect them. One of the first things is asset protection. You've worked hard, you're protecting your wealth. And again, tax minimization legally, okay? Some people want to hide their wealth from the public eye. Retirement planning. Where are you towards retirement? Are you achieving your objectives? Are you close or far? What are you doing for retirement planning? And again, family succession. The wealth that you've created, you can't take it with you. How are you going to pass it on to the next generation? Are you going to be like one of the clients mentioned, let them fight over it? Or are you going to structure it in a way for it to transition smoothly and simply for them? That's very important. So what are the taxes on property? So first of all, you've got income tax. For example, if you've got an investment property that you're generating rent from, that is taxed as part of your income. Capital gains tax, people refer to it as a separate tax, but it's also part of the income tax. It's just the calculation that gets added to your income, and marginal tax rates are paid on that. So it's very important to plan for that. Stamp duty is another state tax, which is when people buy, and there's a lot of talk about changing it, but nothing has materialized yet. Land tax and is another state tax that's paid on the value of the land. In Queensland has a generous land tax threshold for trusts, which is not available as generous in other states like New South Wales, which is 0, or Victoria, which is very low. Other things to consider are the rates, council rates, water rates, levies. And if you're going to be involved in commercial property, GST is another consideration because GST is applicable on commercial properties in certain cases. All right, capital gains tax. Capital gains tax is nothing more than a calculation, and it gets added to your tax return. So it's a calculation which is the sales price, which is a fact, and the cost base. Cost base is where there is a lot of people miss out on a lot of things. So it's very important to make sure you're claiming everything as part of your cost base and keeping good records. There are certain concessions for capital gains tax, and again, there is talk in the media, but right now it's there, so use it if you can. If you've owned the asset for more than 12 months, whether it be shares, whether it be property, you can get a 50% CGT discount. This is not applicable though for main residents since for non-residents since 2012. And also since 2020, the main residence exemption has been disallowed for non-residents. So if you sell your main residence while you're a non-resident, you do not get any benefit and you're taxed on the full amount. So we're getting a lot of people caught out on that that are not aware, and we're getting questions about it quite regularly as well. So the tax tip here is maximize your cost base, maintain good documentation. ATO is becoming a lot more aggressive in their audits. They are a lot more painful. So make sure you have good documentation that supports your position. Solicitor settlement statements or letters, any renovation expense, depreciation reports, keep good records. I think that is a very important tip. And the other thing, which is very important to realize, is capital gains tax is only payable if there is a sale and there is a gain. So if you make a loss, there is no capital gain. And again, back to the timing issue. If you sell an asset with a capital gain, and then the following year you sell an asset with a capital loss, you pay tax on the capital gain and the loss is carried forward. So timing, maybe selling them both in the same year, is something to consider. And again, not to do washout transactions, but it's something to consider. Again, there is talk of taxing capital gains, unrealized capital gains. It hasn't been done yet, but watch this space. So what are the considerations for ownership? First of all, what's your risk profile? Are you in a high-risk role, like most of the list that Luke said, doctors, lawyers, accountants? Are you in a high-risk role? What asset protection do you need? Or are you in a low-risk, you've got a low-risk profile with only, for example, a PAYG income? Your income tax, how do you minimize it? What level of income tax do you have? What's your group family unit look like? What are the options there? Okay, there's always trade-offs. Do you want asset protection? You might not get tax minimization. You want tax minimization. When you go to Luke, you might not be able to get the loan because you're not making income. It's always good to assess what you want and reach that sweet spot where you're getting most of what you want. All right. Your retirement age. What age are you? Where are you from retirement? What's your plan? Family succession, how you're going to leave the assets to the kids. All these are very important considerations to look at. What's the future outlook? Do you need cash flow now or do you need it in the future? And most importantly, the lender limits, because I have a meeting maybe once or twice at least a week with a client saying, I want to buy 5 properties in 5 years. In some cases, they do. In other cases, they get stuck because of the lending limits on the third property. And this is where you speak to Luke or your mortgage broker. All right, investment structures. I've referred to them a lot. What are they? Okay, it's basically who owns the property or who owns the assets. First of all, you've got individuals. That's the simplest one. You go, you sign your name on the contract, you've bought it. The downside of individuals is they can sue and be sued in their individual name, which exposes the asset to risk. And the other thing is there is minimal tax planning you can do with individuals, because if they own the asset, they are taxed on it. Then you've got partnerships, which is starting to split the income. Let's say a husband and wife buy a property together. The downside with that is each partner is exposed to the other partner's risk. So there isn't a lot of asset protection. And again, there isn't a lot of tax planning other than the initial split. Then you've got companies. Companies are legal entities under the Corporations Act. Okay, they've got limited liability, which is very good, assuming you haven't breached certain rules, and they have also continuation. Okay, companies are very good for operating businesses, but they're not as good as other entities for owning assets that appreciate in value, because companies will be taxed at a lower tax rate in the company, but once the distributions or dividends are distributed to the individual, they may have to pay a top-up tax. Okay, so companies have certain benefits, but owning assets that appreciate in time, in most cases, you will get a worse outcome in a company than other entities. And what are the other entities? What other options are there? Trusts, which I'll go into more details later on, and super funds. Okay, self-managed super funds as an option for an investment structure as well. All right, the history of super funds. Again, I ask this question a lot. Do you know what the history of super funds are? Back in the day, you know, Russell Crowe, the movie Robin Hood. All right, King Richard wanted to go crusading. Middle Ages, King Richard wanted to go crusading. He goes around his friends, you know, looks around. They don't want to go because if they go, they get an arrow in the back, they die, king takes their land. They don't go, they're a traitor, kills them and takes their land. So it wasn't a very good situation for them. They went to the educated elite and asked them, what do we do? So at the time, the monks were the educated elite, and they told them, set up a structure. Do you want to own the property, or do you want to benefit from the property and control it? So they said, well, we don't really care who owns it, as long as we control it and we benefit from it. That's the basic background. So in the example of King Richard, he went to his brother, Prince John, and said, I appoint you as trustee, thereby making him the legal owner of the lands and estates of England. That was the asset or the corpus of the trust, okay? For the benefit of the people. So the people were the beneficiaries who will benefit from the lands and estates, but they will pay the tax. And that is the relationship. By these few words, he set up a relationship of the trustee, which is the legal owner, the asset or the trust corpus, which is the lands and estates of England in this case, and the beneficiaries, which are the people of England who benefit and pay the tax. These days, we prefer the trustee to be a corporate entity, a company, so that there is limited liability and succession. Because if it's an individual, that individual becomes incapacitated or dies, there is a lot of paperwork that can be done. If it's a company, the ownership hasn't changed, but the control of that company changes and can be passed much more smoothly. Again, the discretionary trust the trustee will own the assets for the benefit of the trust. And from there, they can distribute to whoever is eligible. And again, minors can only get $416. Otherwise, they're taxed at punitive rates from a discretionary trust. So usually the distributions go to either a beneficiary company or the adult beneficiaries. All right, what are or why use a trust? What are the advantages of trust? First of all, asset protection. Okay, because it's a separate legal entity, neither of, in this example, mom and dad actually own the asset, but they benefit from it. Okay, so if there is, dad gets in trouble, he doesn't own the assets in the trust. Okay, and again, there are certain rules around it, so it's quite strict. You can't do it to avoid your creditors. You can't do it for certain reasons. But if you set it up for the correct reason, you are putting hurdles in front of people to make it harder to attack you. Okay? So protect your assets is a key thing. Minimize your tax. It gives you tax planning beneficiary because, again, in this example, let's say mom is staying at home with the kids. She makes very little income. Or dad is staying at home with the kids. Whoever is on a lower income, you can give them more of the distribution to benefit from the marginal tax rates that I spoke about before. Streaming of capital gains and franked dividends. Again, in a trust, I mentioned in a company, if you own assets that are appreciate in value, you don't benefit from the capital gains discount. In a trust, you can. So if you stream the income, the capital gain to certain individuals, they can benefit from the 50% CGT tax discount. And if you stream it, for example, to someone who has a capital loss, they might not even need to pay any tax on the capital gains. Also, franked dividends can be streamed to individuals who will benefit from the franking credits. It helps you hide your assets from the public eye. Again, helps with succession planning, makes it a lot simpler and minimizes the cost for succession planning. And finally, retirement planning, it maximizes the benefits. There are disadvantages for trusts as well. Land tax, particularly in New South Wales, there is no threshold. So you start paying land tax from $0. What that does, or that if you've already paying land tax, it becomes a mooted point. If you've already got assets in New South Wales that you're paying land tax on, then that becomes a mooted point. Again, all these factors are assessed when we're looking at whether you should set up a trust or not. The setup costs, again, take the long-term view or the long game. Overall, it will be material compared to the asset growth and things like that. Complexity at the beginning, we're here to help you. We explain it to you, we give you the information, you ask questions. So the complexity, make sure you get an advisor who explains it to you and helps you understand why you're doing it. Mm-hmm. Dealing with financiers, again, 5 years ago, it was a lot harder to get funding in a trust. Now, a lot more people are coming to me asking for trust formations so that they can get financed. Again, like Luke mentioned, don't overextend yourself. Make sure you're able to repay the loans. But if you've got an additional option, trust could be helping in that. Another downside is foreign persons land tax and stamp duty premiums. If the trust is deemed to be a foreign person, then there are premiums that have to be paid. Again, this can be fixed in the trust deed, and it's not applicable for commercial property. It's only applicable for residential property. Unit trusts are a kind of trust which fixes the each person's income and capital portion. It's very good for a group of people to pool their money together to maybe go into a bigger deal that each one of them couldn't do on their own. It allows for streaming, streamlined, and it also allows for the streaming, simplified management. This is something you can consider if you're looking for a deal. Again, get specific advice to your situation. The good question is to trust or not. That is the question. Consider your risk profile. What's yours? Is it high? Then yes. Is it low? Then maybe. What's the cash flow? Is the property going to produce positive cash flow or negative cash flow? If it's negative cash flow, the losses are quarantined in the trust and you can't offset them against your other income. But they accumulate in the trust, and maybe when you sell the property in the future or when it starts generating income, it will net off. So that's something to consider as well. Again, like Luke said, get professional advice. It's very important. I get asked a lot of questions. Can I didn't know this information. I bought the property in my individual name. Can I change it now? And the answer is always yes. But how much is it going to cost you? Stamp duty, capital gains tax, a lot of different things that had you considered the situation in the future, it would have been a lot better. And plan with each property, because the situation has changed, circumstances change. You need to assess with each new property. Okay, I'll quickly touch on Super. Super is a very good structure or self-managed super funds is a very good structure to own property. One of the biggest advantages is the tax rate is only at 15%. And for capital gains tax, for properties that have been held for longer than a year, it's only 10%. It's very good for asset protection against creditors. There is no tax in pension phase, depending on your balance in the super fund. And usually lenders, and again, this is a discussion you can have with Luke, lenders don't consider it as part of your borrowing capacity. So people, when they reach their third property, if they've got enough in their super fund, might start looking at super fund to buy their fourth property. Again, options. Disadvantages is depending on where you are in life, you might not be able to get the cash out until retirement. So if you need the cash flow, it might not be suitable. If it's a very low balance, then it's definitely not suitable. It's good for contributions when you're age 50 or plus, so that you're closer to getting the money out. The contribution limits has a lot of limits, so $30,000 per year as a concession contributions. There are other rules around that. Liquidity to pay retiring members. So if there are people in retirement, you need the liquidity to pay them certain amounts. So if the super fund only has bulky assets that don't generate a lot of income, you might need to liquidate some of the assets in the super fund. The other thing is the detailed administration for super fund, because there are a lot of tax concessions. The ATO requires a lot of detailed administration. Again, we help with that. All right. Consider how much it will cost you if you get it wrong. And again, I see that very regularly with a lot of initial consults that I have. Compare that to the value of good advice. Again, advice before action. Calculate the economics, cash flow of the proposed transaction. I had a client come to me recently. He bought a piece of land for 900,000. He was going to build a duplex on it for, I think, another 900,000, and he was going to sell each duplex for 800,000 at the end. I told him, give me 150,000 now, dollars, and we're both better off. Walk away from the transaction. He didn't understand the joke I was trying to mention, but at the end, he did sell the property because he'd held it for a while. He did make some money on it, but had he gone through with the proposal, he would have lost money. Discuss the proposed strategy. Again, plan ownership, structure, exit. Look at the exit. Start with the end in mind. Get professional advice. Okay, I'll quickly touch on what we do. We provide advice on structure and formation, compliance, tax returns, GST, capital gains tax calculation, SMSF, analysis, cash flow analysis. Again, I've got a few private rulings with the ATO right now, which are quite interesting. And some tax research. Sometimes a client comes to us with a specific situation. We help them with the tax research. And because I'm a limited advisor with Merit Wealth, I can provide advice on SMSF formation and compliance. And the people we help, very briefly, it's aspiring investors, people who are looking to buy their first property, experienced investors who have already started their property acquisition and wealth journey, and veteran investors who have multiple properties. They've got business income, they've got the structures, they've got the SMSF subdivision. And the more you go along that journey, the more opportunities for tax planning and tax advice there are. And again, this is the code for the consultation, and I believe there'll be Q&A at the end. I hope I didn't go over too much.
You have been amazing. You have been spot on time. Thank you so much for sharing your wisdom. Well done. So a round of applause, everyone. Just want to say thank you, Emil. Look, I know that when we've referred, do you mind just not sharing your screen? Thank you.
Yep.
Not sharing mine. But when we've referred our clients to you, Emil, they've all given really good a good rap, and yeah, I've got a really good experience. So thank you so much. Look, for the last part of today's presentation, I'm just going to briefly touch on a couple of things. About how to get set for life. It really, just we started obviously with Luke talking about how to get funding and get your finance. That's super important to get the right finance structure set up. And then Amir obviously talking about different kinds of structures and really thinking about what method you're going to do or what strategy you're going to do from a tax perspective is really important before you go down the property journey. So let's have a look at where we go from here. So hang on a second. Here we go. So I want to talk about the why of property investing, just very briefly. This is a bit unusual. I don't know.
Is that you, Rich?
Yeah, that is me, mate. Yeah. So, and this is one of my bucket lists. I'm actually at a phase now of life where I've built a substantial portfolio, and I'm really enjoying this phase of life, helping people achieve their goals and dreams. So this was one of my visions, to swim with my wife. It's just there, it was there, and I swim with whale sharks a couple of weeks ago at Exmouth in Niggala Reef at WA. So it's been on our bucket list for some time. Now they're not really sharks. They're actually the world's largest fish, and they're like 7 or 8 meters long. But it was an incredible experience, and we thoroughly enjoyed it. So what I'm saying is that property investing allows you to do these kind of things. Again, I'm a real nature nut. I love being in nature. This is called Nature's Window, actually, at Kalbarri in WA. And doing this property investing allows me to take time off. My business keeps running. I've got a great team. But when you don't just do property investing just to make money. Money is a means to an end. And I really ask you, what is that goal that you have? It might be to provide for your family. It might be to travel. This is me at Akaroa in New Zealand earlier in the year. We did a 3-day walk and had a fantastic experience. So this is one of my happy places where I get energized. But I want you to have a think about your happy place, what it is that motivates you, and then use that as an incentive to keep investing. So, a couple of things I want to talk about today. The next super cycle, how to get ready for retirement, brief market update, undersupply of property, a bit about locations and strategies, and the buying process. So let's whip into it. This is going to be a quick, fast presentation, hard hitting. So I'm going to go fast. Key thing to remember is that this is a quick history lesson, when we get interest rate cut cycles, which is what we're going through right now, for the next couple of years, we are going to see interest rates come down for various reasons. And what happens when rates come down is loans are more affordable. Suddenly property is apparently more affordable, but more people will enter the market to buy a limited pool of properties. So if you look back over the last many, many decades, you can see here, every time there's a rate cut, there's a significant rise in property prices. This is on average. This is a study by the Bank of Queensland. So just a thing to remember, keep in mind. I mentioned about setting goals, and again, just come back to this. I use a financial planner, I use a finance broker, I use an accountant. I've got a really great team around me to help me achieve my goals, and it's really important to understand what drives you. And I reckon probably 5% of people, even on this call, may have written goals. I can't ask you to put your hand up if you do, but every year I write down my goals, my physical, spiritual, mental, financial, business goals, and I look at those every month and keep myself on track. So it's important to really have a goal system in your life that keeps you on track. So another question for you. How many properties do you need to retire? You may not want to retire. Really, the question should be, how many properties do you want to generate X dollars in cash flow is probably a better question. So here's the menu, right? So if you want to earn $100,000, you're going to need a net asset value of 2.5 million. Now, I'm basing this on a very conservative 4% rental yield, okay? There are some properties you can get higher net yields or higher gross yields as well. So that means you're going to need to get around 7.1 properties over a period of time. If you want 200 grand in income, then you're going to need $5 million worth of net assets, which means you need to invest about 10 million over a period of time, which means you might need around 14 properties at 700 each. So these are just very simple, high-level crunch numbers. You don't look too much into the detail. You'll pull it apart, I'm sure, with the decimal points, but you can play around with it. But there's a way in which you can simply turn 150K into a $5 million portfolio in roughly about 10 years. If you start with that 150K and you do what's called debt recycling, you basically reinvest the capital growth that you've earned, and you buy good quality assets, then based in buying the right locations, it's a pretty simple process. Now, once I understood this, 30 odd years ago when I started investing, the lights went on and I bought 3 properties in 1 year. It was fantastic. So it's not rocket science. You can do the same thing. Now, for anyone on this call today, we've actually just, with our new head of research, Husband, he's created a fantastic retirement calculator, which I'm happy to share with everybody today. Just send us an email to the responsive, we'll send it out to you. But you can put in your own numbers, play with the figures. I won't do it now, we haven't got time. But you can play around with the numbers and go, okay, I want X dollars in income, I want 100, I want 200, I want 300, whatever you want. And it will calculate pretty quickly how many properties and over what period of time you might be able to achieve them. Now, this is going to depend very much on your borrowing capacity, which Luke talked about earlier today, but it's a great tool to do some planning with. And then when you buy those properties, here's another spreadsheet that we'll give you today. You're very welcome to have, that we created, again, based on my own. This is not my own personal portfolio here, but this is just based on the format where you can track all of your properties and your wealth. So we've created a fantastic spreadsheet. Talk about cost-based in here. I've put in this spreadsheet, a really nice spreadsheet you should be giving me a gold star for. So we send this to our clients, say, track your conveyancing costs, your accounting costs, your property management costs. So it's really nice for the accountant. So hopefully you'll give us a nice slap on the back for that one. But again, we're happy to share that with you. So let's do a quick a snapshot of the market. Right now, we're seeing consumer confidence still reasonably good. We're sort of a bit more upbeat. It's holding the last month in July. The Westpac Consumer Index rose a couple of minor points up to 0.93%. So we're not quite back to real positivity yet. We had a big dive during COVID, you can see there, but we're now sort of sitting at around 93 points. So we're still facing some uncertainty. Auction clearance rates have been really strong. Actually, they're approaching what I call boom time conditions at the moment because of the lack of stock. So these are the results last weekend. We saw Sydney had a 77% clearance, Melbourne 78. So very, very, very strong clearance rates on smaller numbers. So that's a good leading indicator to watch as we head into the spring season. If we look at the 3-month price changes that Cotality, as the new name for CoreLogic, have brought forward, we can see all the capital cities are in positive territory. Now, I don't pay too much attention to the 3-month numbers. They do provide a bit of an indicator. I much prefer to look at the 12-month numbers. Now, if we go to the 12-month numbers, we can see that Darwin's done 6%, Hobart 2%, Perth 7%, Adelaide 8%. Brisbane 7%, Melbourne's almost breaking even again, and Sydney's at 1.3. Now, the thing that when I put this slide up, people go, "Oh, Rich, well, I should just buy in Darwin because it's highest number." Again, that's only a 12-month period. You must look at the performance of each capital city on its own merits and a whole raft of other indicators, not just a 3-month or 12-month indicator. And I'll talk about that a little bit later in the presentation on where to buy. So here's the capital city median and unit house prices. So to buy an average house in Sydney, it's almost 1.7 million bucks. Wow, that's getting high. In Melbourne, it's just over $1 million. Brisbane, it's just over $1 million. Adelaide, it's hitting $1 million. Canberra, it's over $1 million. Perth's almost there. Hobart, 710, and Darwin, 659. So there's some big numbers, right? But it's just good to put that in context of what you need to spend to get a basic house. If we look at listing volumes, this is a really big indicator of the supply and demand in the market, or supply, I should say, in the market. So currently, all total listings, the number of total listings is sitting at around almost 17% below the 5-year average. So that tells me that where the people aren't trading their properties enough, or they're not listing their properties easily for a whole bunch of reasons, stamp duty or concerns about the market or just personal circumstance. But that is an indicator of undersupply, which I'll also touch on in a minute. And here's another reason why we're not building enough properties. You can see here, we're building almost the decade average on houses, but apartments are way down. You're down about, 20 to 30% below what we should be building in apartments. So there's a massive constraint in supply in the apartment market, simply because developers don't believe it's feasible to make enough profit. Rental growth is slowing, so good news if you're a renter. So let's talk about immigration and housing supply. So we had a massive drop-off in immigration during COVID, a massive rebound, and we're still seeing significant numbers of migrants coming through. Now that's putting massive pressure on the market. So this chart here by ABS and AMP show that this green line here shows the cumulative undersupply. So we are continually undersupplied. At the moment, we're sitting at about 220,000 dwellings undersupplied across Australia. So for me, this is what I call my safety net. I love this chart because for me as an investor, I'm very happy that, I'm not happy, but I'm happy that there's not going to be a saturation of the market of new properties coming on. So that indicates to me there's going to be strong capital growth, and that's why I call it a super cycle coming over the next 5 to 10 years. We have continual migration, continual population growth, and if we don't have enough properties, guess what happens? Property prices will continue to rise. And here's another thing, the population numbers. So we're currently sitting at around 28 million, but by the year 2050, we'll probably have around 40 million people in Australia. All right, market timing. These are the bank forecasts. You can analyze them to your heart's content later. I actually interviewed some of these bank economists last year. I've interviewed the NAB economist and the HSBC economist on my podcast. But without saying it to their face, they notoriously get it wrong, right? They're obviously very conservative and often get it wrong for all sorts of reasons. Here's my personal forecasts over the next 12 months of where I think prices are going to go for each capital city. And I'll delve into the reasons shortly as to where that goes. I know I'm going quick, and I've got a lot to get through today. But here we go. So if you look at the last 25 years worth of history, and this is what I've analysed between the year 2005 and 2025, taking the median core logic number or totality number of 1.47 for a median property value, and you extrapolate that at 7.3% over 25 years, over 20 years, let's say, then Sydney's median house price will be 5.4 million bucks. Now, I hope that doesn't frighten you. I hope that motivates you to get into the market, because there's going to continue to be a bigger gap between those that own property, unfortunately, and those that don't own property. The number of renters is about 30%, but I predict within the next, say, 10 years, we'll probably have 33 to 35% of people renting rather than owning a property, just because it's simply becoming more unaffordable for those who unfortunately don't have parents or the ability to buy property. I'll skip over that. So how do we choose properties? That's probably an important question to ask. How do you select the right kind of property to buy? So I'll give you 10 tips, and then you can download the rest of the other tips from our website. Firstly, I look for property prices that are close to the median. I like to buy just above the median, typically in a location. And the reason being, it gets me a better quality of property. And also there's a number of buyers to buy it should I need to sell that property in a hurry. I like to look for what I call undervalued or bridesmaid areas. So there might have been growth in one suburb, but the adjoining suburbs perhaps don't have had experienced that growth, and they get the ripple effect of growth. So I look for those, outlying areas just surrounding some really good areas. I also typically always buy land and a freestanding house on a block of land. I do buy apartments, but for our clients, but we find that the houses, if you go back to that slide a couple slides ago about the difference between houses and apartments, houses typically perform 2 to 3% better per year capital growth wise than apartments. I look for something that's got value add potential, got a strong yield, it's close to shop, schools and transport, it's in a good zoning area, and a big one where there's a large percentage of owner occupiers as well. So there's the 10. Now, if you want to get the full report and description of that, again, you can just scan that code, and you can download a whole bunch of other free resources there on the website. Again, I'll be sending this around today, so don't stress if you don't have time to grab it right now. All right, when is the right time to buy? Well, the right time to buy was yesterday or before COVID, wasn't it, Luke? In a year, but
That's correct. Yeah.
but look, honestly,
We
the
wind
right
the
time
clock
to buy
back.
is when you have borrowing capacity. I think I was going to shout out one thing in Luke's presentation is there's a huge opportunity cost every year that goes by where you've got borrowing capacity but don't use it. So I'm always talking to my broker, always reevaluating where my numbers are at, saying, can I pull some equity out of this property? Where have I got some wiggle room to go? How are the rates? So always be looking at your borrowing capacity and protect that, because that is your golden egg that lays the golden goose. The golden goose that lays the golden egg, I should say. So the right time to buy is when you can afford to buy and when you're able to buy. But there's some good reasons to buy right now, simply because we're in a rate cut cycle, and that's going to mean prices are rising, and we've got low vacancy, very low vacancy, rental crisis, and low building supply. So all very, very good reasons to buy now. All right, so I mentioned I'd talk about location. So here's the secret sauce. So where are we buying? We're buying in all of the major capital cities, but again, there's not a one size fits all. Where Luke buys or where Amir buys or where Sally or Bob buys might be completely different for various reasons. We have clients that have got 3 properties in Melbourne, for example, and none in Brisbane or Sydney or Newcastle, right? So you do need to think about diversifying your portfolio. You've got to think about land tax and minimizing that across different jurisdictions, but also take advantage of different property cycles. So where are we at now? Well, Sydney is still going to be entering into a new growth phase. Even though it's got a high price, it's still going to perform quite well. So around the airport, Western Sydney, some good opportunities, good value on the northern beaches in certain pockets. The eastern suburbs is always a continued tried and tested blue chip area. Inner West is also really good, but particularly areas that are benefiting from the metro train line is very important. Brisbane is getting the best combination of growth and yield. We're putting a lot of our investors into Brisbane, and we'll continue to do so because of lack of supply, massive infrastructure growth, vacancy rates 0.9%, and then you've got the Olympics coming in 2032. And off the back of that, you've also got spin-off growth to both the Gold Coast and Sunshine Coast. Very highly attractive lifestyle areas, much more affordable properties, very attractive And people are now moving to those locations from Sydney, particularly, where you've got a big outflow of interstate migration, and around 30,000 people a year migrating to southeast Queensland. So brilliant for investing opportunities. We're also seeing Central Coast and Newcastle have been really strong performers. We're seeing yields there around 4 to even mid 4%. Perth, I'd probably just put a bit of caution on. Still buying there, but again, its longevity compared to other capital cities, I'd just be cautious about. Adelaide, again, good performer. Melbourne is very early in the cycle, so really good opportunity to buy early in the property cycle in Melbourne. The yields are a little bit lower, so you've got to possibly consider negative gearing a property there, but definitely Melbourne has some excellent opportunities. And for those chasing yield, then we were buying in the large regionals like Townsville, Mackay, Bundaberg, Airlie Beach, Rockhampton, etc. And we're getting some great deals there. So there's the secret sauce. Strategies. I haven't got time to go into strategies today, except to say, don't keep chopping and changing your strategy. Pick a strategy, work with it, and don't get options anxiety when you're looking at various strategies. All right, so let's just quickly look at 7 steps to buying well. I'll let everybody look at this later on in terms of where you're at. As I said, we offer a full buyer's advocacy service. What I was going to say today, in terms of our clients, a bit like Amir, we have a huge raft of different clients right across the spectrum, from home buyers, prestige buyers, commercial buyers, investors, and people buying in self-managed super funds. So we help people who've got, say 500K through to whatever budget they might like to invest or buy with. So there's no problem, no distinction on budgets that we work with. One thing I'll say today is we are offering a special, and if you do sign up with us before the 15th of August next month, you'll get 10% off the engagement fee. So that's a $300 to $500 discount off our normal. You just got to put the promo code set for life in the email when you engage with us. So just to finish off my part before we go to the Q&A, I'll just want to quickly look at a couple of case studies just to kind of whet your appetite for what you can achieve. Now, I've mentioned this one a couple of times in other presentations, but granny flats for me is a really great strategy we've used multiple times in our own portfolio. I bought this property on the Northern Beaches for 850 grand in 2008. And at the time I rented it for 750. I've since renovated the house inside and the granny flat. We're now getting over $2,000 a week for the combined rental, and it's now worth about 3.1 million bucks. So simply just doing a simple reno and hanging onto a property, it can perform really, really well. And yes, Amir, I've got this in a trust as well, which means I've got to pay land tax, which is a pain. But anyway, all right. So a couple of other ones. We just bought this property last week for a client up in Townsville, 650 grand. It's just getting over 5% yield. Again, bought this within 2 weeks of engagement. Now, the Townsville market is very, very hot, very difficult to buy there if you're trying to do it on your own. Majority of what we buy up there is particularly off market to get those kind of yields. Here's another one we just bought in Brisbane earlier this year. Really nice quality 4-bed, 2-bathroom house for 727,000. So the value you get in the Brisbane market is quite remarkable when you compare it to, say, Sydney. The quality of the properties and the yields you get are just vastly different. I've got a whole bunch of slides here, but I'll just zip through a couple. This was one we bought in Melbourne, beginning of the year. It was a 3-bed house. We purchased that for 680, got it below our appraisal price. Again, just simply our relationship with the agent enabled us to get that for a really good price. And I'm going to jump to this one here, 64. All right, this one we bought on the Central Coast. We appraised it at 930,000. We managed to get this for 895. Rents for 780 a week. So very well looked after property. Anthony Knight, our buyer's agent up there, did a great job of negotiating that. And I think that's one of the advantages of using a buyer's agent, having someone independent who will negotiate, evaluate, and step in on your behalf to put your interests first. Okay, we've got 2 more, and then we're going to go to Q&A. So this was, we go back one here. Another one we bought in Brisbane in April. We appraised this at $1 million, got it for 975. Rents for 950 a week, so really strong return. But it's almost a near new home, incredibly good value, and we managed to get below bank val, which is almost unheard of, right? Luke, would you agree? Really hard to get it below bank val, right?
I think I can count on one hand how many properties have come in, or how many properties have been purchased below bank val in
Yeah.
20 years. Yeah,
There you go.
doesn't happen.
So we occasionally jag one. This is one of them. So very,
Yeah,
very happy client on that experience. Yeah. All right, and the last one we'll do another one we bought in Sydney, eastern suburbs at Hillsdale. We just got a really great two bed, one bath, one car unit for 1.1, rents for 850 a week, so a pretty decent yield at just over 4%. And again, found that off market through our connections, and yeah, just had to be really persistent because as you know, the eastern suburbs is a very, very competitive market. So look, that's we're going to do to question and answer. All my details will be on there, and I'll just stop sharing. How do I get back to here? So look, we've got a bunch of questions, guys, and so we'll just rip into it. I'll go right back to the beginning. Can you guys see the Q&A box on your screen? Just if you pull up the Q&A box. So
mate, I've already answered a few of them on there. I don't know if you sort of in
Okay,
writing.
if you've already answered them, we'll skip over them. But Andrew's saying there's a Great Depression coming. Should I see him? Wait, I love the bear mongers. That's great. Well, a lot of people sit on the sidelines because they're frustrated. For me, you've got to learn to invest despite the uncertainty, and you know, hope for the best, prepare for the worst. But if you invest purely thinking you'll stop doing anything because you think a depression's coming, you'll miss out. Recommendations for purely commercial property portfolio. Best strategy to get into commercial tax implications. So yeah, question for that person. I love commercial property. It's great. I do own commercial property as well. Great thing to have. But what I'd say is I typically recommend our clients get maybe three, maybe four properties in resi first because there's higher risks with commercial, particularly vacancy. You don't want to be stuck in a situation buying the wrong type of commercial property, particularly retail, for example, and then get a COVID situation where you have got to pay a massive mortgage, but you can't evict the tenant because the government's put a moratorium on evictions. So just be super careful with commercial, but absolutely, if you've got the right amount of money, you typically need higher amounts of money to get into a good quality commercial. I like to buy industrial, say 1.5 plus, whereas you could potentially buy two resi properties for that to get started. One for you, Amir. Ed is asking if the structure is under a corporate trust, would the loan become an investor loan, not an owner-occupier loan?
All right. So first of all, it's if you're looking for a main residence owner occupier and you buy the property in a trust, you lose your main residence exemption because the person who owns it has to live in it. If it's a trust owns it, then it's not you, and you can't benefit from the main residence exemption. Again, the that's my reading of it. If they're asking, can they buy a main residence in a trust? If that's the question, I wouldn't suggest it at all. If it's a question around can they get an owner-occupier loan for a property in a trust, I think Luke would be better placed in
Yeah,
that.
look, in my experience, surely if you're buying a trust with intention limits, it's a bit of a tax play, isn't it? It's you're buying it because you want to rent it back off the trust. The trust is a different entity. It's not you as an individual. So we see that quite often with self-managed super funds and trusts buying commercial properties, which they then want to rent back off the SMSF or the trust. For tax purposes and asset protection. So yeah, it's not something that we see a lot of from an owner-occupier perspective.
Mm.
Yeah.
Another one for you.
My understanding would be it would be an investor loan.
Yeah.
I think that's
Correct.
Yeah. Someone else asked, I'm the sole owner of a property. How can I split the rental income to lower income earner, e.g., with my daughter or my wife?
That is the question I said I get most asked a few times a week. Again, you have to transfer. The only way to do it is you transfer it. Even if you gift it, there is stamp duty implications and capital gains tax implications. So getting the right advice at the start, always better.
Yeah. So
It's important to set up the right structure from the beginning. Once you've bought the property, it's sort of
exactly. Once you've signed on the dotted line, it's too late.
It's too late. So if you've already bought it, I mean, you could have bought it 50% each, or 70, 25 or whatever, or buy it in the company or buy it in a trust. So again, just say get the right advice. How can I minimize income tax on rental income if I've paid down my mortgage? No offset facility, but redraw available. Question by Brian. One for you, Luke.
We see clients who have paid down their mortgage on their owner-occupied property. Is that what they're saying? Sorry, is that the
Yeah,
question?
how can I minimize income tax on rental income if they've already paid down the mortgage?
On the investment property, not the
Yeah.
rental. I think this is more
Isn't that a
mine.
tax question?
Oh,
That's a tax question.
Yeah,
Yeah.
yeah,
yeah.
sorry, sorry, me. It's a tax question then. Yeah.
So look, again, if you've paid down the loan, that's gone. And that's why even redraw facilities are not as good as offsets, because offset, you have the money in the account. If you take the money out and use it for whatever, it is your money. If it's a redraw facility, you take the money out and you buy a car, that might not be deductible. So again, if you've repaid the loan, that's gone against that property. So make sure you get the depreciation report. And I saw a question around depreciation. Yes, always get a depreciation report. There are specialized QS, they're tax agents, but they're actually engineers. They provide it. Not every tax agent can provide it.
Yep.
I think if you're redrawing the funds for investment use, if
For
you're going
investment use, yeah,
to
a
improve the
separate
value
property.
of the investment property or to buy shares or something, then
Yep,
might
yep.
be
It
a way
depends on the
to.
use. So it depends on,
Yeah.
so the deductibility is the use of funds. So if you buy a personal car, you can't deduct it. If you buy another investment property, it'll be against that investment property, but it's gone against the first property.
Yep.
Yep.
Okay. Livio is asking, are trusts also referred to companies when purchasing properties?
I'm not clear on that question, but usually there is a company that's the trustee, and the trust is the trust.
Okay.
So if you buy it in a company, like I said, you lose a lot of tax advantages. But again, each case is different, and we work with whatever the
Yep.
scenario is.
Got it. Okay. So do you recommend getting a tax depreciation report? Absolutely. 100% get a tax depreciation report. There's a number of companies. We actually have a company that works with us that we can get it done for $500 through Asset Economics. There's also BMT, there's Depreciator, and Washington Brown. But yeah, they'll cost anywhere from $750 to $500, but absolutely worth it. Give
Yep.
it to your accountant, and they'll put all the numbers into the claim.
And always chat to them. Most of them will tell you, is it worth it or not? And can they get you a bigger deduction
Hmm.
more than the fees, basically? So is
Yeah,
it in
cool.
your interest or not?
Okay, two more tax questions here. The cost of setting up a trust, and also, do I need to set up a trust to purchase properties in a self-managed super fund?
So self-managed super fund, yes, you need to set up a self-managed super fund, and that's a whole separate process. Cost of setting up a trust ranges between $3,000 and $4,000. That's with the trustee and all the process with it.
Yep. Okay. All right. There's a lot of questions about setting up. That's more mechanics.
There was one there, Rich, which it was a bit of a recurring question. I saw a few people ask the
Yep.
same question. Can you get a loan if you're 60 or sort of I suppose reaching retirement age? And the answer is yes. We do these all the time. We can even get a 30-year loan. I did a 30-year loan the other day for a 62-year-old who had a 10% deposit, was buying her first property as an investment. She was renting
Mm,
and she was reliant. She did work part time, was earning some income, PAYG, but also
mm,
getting some money from her super, the transition to retirement income from super. And we got her a 30-year loan. So as long as it makes sense, right? The banks don't or aren't allowed to discriminate against age.
mm,
So this particular applicant, she was able to service the loan repayments for the next 7, 8, 9 years on a combination of her PAYG income and her transition to retirement income.
mm.
And then her exit strategy was that when she sold the property, there was some more money left over in super to pay out the residual balance that would have been applicable at that time. And also just sell the property and use the capital gains to complement her super. So where there's a strong exit strategy, it can be done.
Yeah, great. Another tax deductibility question from Anonymous. Can interest paid on equity released from an investment property owned in a partnership and loaned to a trust to buy property be included in tax returns by the partners?
All right, that's not very straightforward, but generally the logic is if the funds are used for investment purposes. So let's say you borrowed $100,000 personally, you on lent that to the trust. There has to be a commercial use. So you have to make some money on that. The trust will claim the deduction, let's say $10. You can can claim that $10 as income and claim a deduction for the $9 that you made the bank. There has to be a commercial, there has to be correct documentation. Again, it's not straightforward. There has to be correct documentation and a commercial logic for doing that. You can't just borrow from the bank at 9% and lend it to the trust at 2%.
Yep, got it. In setting up these structures, who should they go to? A financial specialist or tax specialist? Well,
go to anyone who knows what they're doing. So it's like get professional advice, whether it's your tax advisor, your financial advisor, your lawyer. Go to someone who knows and is familiar with these structures and knows how they operate and considers your circumstances, because there are some people who just set it up without looking at your circumstances. So
yeah, right.
Again, get the professional advice. As long as you get the professional advice, that's quality advice, doesn't really matter.
Here's a strategy question for me. If there's a fixed budget, is it better to buy multiple properties with lower values or one big property with higher value? That's from Yi Cheng. Well, the answer to that question is it depends on your personal situation and your goals. It depends. I'll be asking you questions, and Yi Cheng, feel free to organize a strategy chat with myself. But yeah, the way to answer that is it depends on your income. What the repayments are going to be. Are you looking for higher growth properties or more balanced or positive cash flow properties? So it really, for me, it's about buying the best quality of properties you can buy, but sometimes there's going to be a strategy to buy smaller ones to get some quick wins, to get some quick cash flow, to keep your serviceability high, or it might be, depending on your age, to buy a larger property. So the answer is it really depends. Someone's asking, how is consumer sentiment measured? It's simply measured by a survey that is done by over 1,200 to 1,200 people, and they ask the same series of questions each time. It's an anonymous survey, and then they publish the results. Melbourne Westpac Institute published those results around how people feel about spending, about interest rates, about their position in finances. What are your thoughts on buying in different states where property price is cheaper compared to Sydney? Absolutely, I agree. That's what I just said. You definitely need to buy in different. Don't be thinking about investing in your own backyard. Think about being an agnostic and borderless investor to buy properties that are going to achieve the best and strongest capital growth. Phenomena. Rich, what are your thoughts on the phenomena I heard about using an increased buyer's agent causing a pool of houses to become limited because the agents are targeting the same locations? Okay, yeah, good question. So the question is sort of suggesting that buyer's agents are kind of moving the market in a sense. So yeah, really good question. So what we do, we look at the data independently of what our competitors are doing. I have 32 staff in my team, all geographically separated, located in different areas. We will look at locations that we believe will provide long-term capital growth or both capital growth and strong yield. So we're very cognizant of areas where we know that have been oversaturated by investors. So we move on from those areas and we don't buy in those areas if they continue to have a flood of investors that is going to cause that market to potentially crash or have a significant long downside. So that's how we do it. When are you buying mainly luxury properties? No, we buy, as I said, we buy properties from 450 grand plus. So we have a wide spectrum of clients. Probably the majority of our clients would be on what I call modest incomes. So don't please get the impression that we just service the uber wealthy. Not at all. We do, but they're not our only candidates. We help people buying their first home, buying their first property, and then we have people buying multiple properties as well. Amir, I've already set up self-managed super fund. Do I need to set up another trust to purchase properties? So yes, you do.
Again,
the bear trust.
That depends. So if you do, again, I'm not clear if she's talking about or he's talking about a discretionary trust or the bear trust. But if it's the bear trust, yes, you need a separate trust for it. If you're asking to acquire more properties, then a discretionary trust, it depends. It'd be good to have a chat.
Yeah, great.
That's outside the trust, so it's super fund. It's separate from the super fund.
Great. Someone's asking me, how do you find properties to recommend to your clients? Do you get a commission from the selling agent? Absolutely. Great. We absolutely do not get a commission from the selling agent. In fact, it is illegal for us to accept commission on any property from a selling agent because that would be a massive conflict of interest. So I've been in this business for 25 years. I was the president of REBA and campaigned very strongly against this kind of behavior that I heard of other buyers agents doing. So no, we only get fee paid by you as the client, by the purchaser in the transaction. How do we find the properties? A number of ways. We're using some pretty cool AI tech at the moment to help us, but primarily it comes through relationship building. So over many, many years, we've developed very long and deep relationships with local agents. So we send out our client briefs to those agents. We call them. We get advance notice. So often before a property ever goes on realestate.com, you'll see it in our inbox first. So that's a very competitive advantage we provide. Someone's asking, is it possible to get positively geared property in land in a main city still? Yeah, great question, Peter. It's a big challenge, so it depends on which city you're talking about. So let's take an example like Sydney. You would need to have multiple income streams from that one property. So I remember maybe 15 years ago, we were buying properties out toward Penrith Way and we were putting on granny flats and we were getting 9% yields back in the day. It was amazing, right? Those same properties today are now worth about, we were buying them at 350 grand back then. Those same properties are worth over 1 million today. And even if you put a granny flat, you're still not going to quite, get a positively geared result. So it depends also on when you say positive geared, how much you're putting in as a deposit on the property as well. So it really comes down to the numbers. So we can find positive geared properties more on the outskirts or through other ways of getting multiple income from the one property. Vicky's asking, what do you think of DHA homes? I'm not a fan, simply because two reasons. One is very high management expenses. They typically charge 15% as a management fee. Secondly, the location is not always optimal. Yes, you've got a great tenant being a defence housing personnel who are obviously going to look after it and they promise to repaint and recarpet it all at the end of the process. But the actual location of that, where that property is may not be optimal for another investor to buy it after you. It's only going to be a segment of the market being defence personnel to buy that property. So they're selling you on the basis of great tenants rather than on all of the other factors you need to look for, which is shops, schools, transport, zoning, constriction of land supply, and all those other 20 criteria that I talk about in that report. Okay, can I nominate my house as a PPR if I've never lived in it if I relocate overseas? Amir, what do you think of that one?
So I've got an audit for now for a client. He wasn't a client. He had an initial consult with him. In the last 2 minutes of the initial consult, he tells me, I've been audited for the last 6 months by the ATO and I'm having trouble. Can you help me? Anyway, he sold 2 investment properties, didn't realize that he had to report them. Again, due to the timing issue, he thought it's on settlement, it's on contract date. One of them was actually his main residence. The ATO, he couldn't prove that it was his main residence. So he had some information, but the ATO was asking for other information. It was a big issue. So there are certain rules for it. You cannot nominate it if you didn't live there, which is the basic one. You've got to have your electricity, utility bills in your name. You've got, again, the key one is you have to actually live there. So the answer is definitely no. Okay. The other important one they were asking for and he couldn't find was the electoral roll. Nomination of the electoral roll for that address as his address. That was, I think, one of the things that he couldn't find.
Right, cool. I'm just noticed it's gone 2 o'clock. I have to make this the last question. Is there any flexibility on your fees? And how do your fees work toward profitability? Is it additional? It's an additional cost. Great question. I love this question. So yeah, look, in terms of our fees, the fee is the fee. If you're going to use any professional, you might think the fee's high or whatever, but at the end of the day, the way we work our fees, we don't negotiate on our fees for a very good reason. If we negotiate and we're soft on our fee, how are we going to be when we're representing you as the purchaser? We don't roll over just because someone asked for a discount. No, we don't. We know that we deliver great value with our fees. It's a bit like asking, should you use the cheapest doctor? Should you use the cheapest dentist, the cheapest accountant, right? The cheapest lawyer, right? You want to use service professionals that believe in their fee and deliver a great service based on their fee. The other thing I'd say is if our fee is, say, it's going to roughly be between 1.5% to 2%. But if a market is moving literally at 1% a month, let's say we take Brisbane, it was moving at 12% the previous year before last. So you're going to be ahead after 2 months anyway. So getting in and buying a great quality asset, potentially off market before anyone else does, you'll be ahead of the game. And we always negotiate the lowest price we can, but bearing in mind there's competition. So don't think of it as an additional cost to factor in. It's an investment in getting knowledge and speeding up the entire process for buying a property. I've got to have to wrap it up there. Look, there's so many more questions. Thank you so much, Luke. Thank you so much for your contribution today, preparing your slides. Amir, thank
Thanks
you
for
as
having us.
well for preparing your slides and sharing your knowledge. I know there's more questions. I'm very sorry, guys. We've run out of time today. We'd love to help anyone who there with asking your questions. Please just reach out to us individually if we can help you. We'll be sending a copy of all of the recording and this webinar and the slides today as well. But thanks again, everybody, for joining us. We look forward to seeing you again on another webinar. Bye for now.
Thank you, everyone.
Thanks.
Bye bye.
Thanks, Rich.
Thanks,
Thanks, everyone.
guys. Bye bye.